Good afternoon, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully all you guys are having a good weekend so far, and hopefully you didn't have that bad of a week in the markets. In terms of ourselves, well, we actually did have a pretty good week in the markets, closing over $6,000 in realized profits. That was a combination of several leap contracts that we've been holding for a while that were finally realized in terms of profits. One of our assignments that we got rid of, NVIDIA, at a nice $600+ profit, and a few wheel trades that also went in our favor as well. So in today's video, guys, we're going to be explaining a few key factors. Number one, of course, we have to explain what is exactly going on in the markets. Why all of a sudden is good news starting to be bad news for the equities markets, and considering the fact that on Friday, we had a very positive jobs report coming out early in the morning, and nevertheless, the markets chose to drop off 1.5%, not only on the SPY, the QQQs, but also pretty much every single index across the board was more red than green, of course, not only on the day of Friday, but to wrap up the week. So what exactly happened? We're going to take a brief look at that to start off today's video. Should be about a 10-15 minute segment, but I think it's going to be one of the most important segments that I've pretty much done since we went over this exact same scenario after Jerome Powell spoke on December the 18th. The volatility has been very high in the markets, and I do believe it will continue. So the first portion of the video will be dedicated to explaining what exactly is happening right now and exactly what we can possibly do as traders and investors to mitigate some of the risks in the market currently. Number two, we're going to be going over some technical analysis in terms of a full market rundown, all of our major sectors, technical analysis, see where the levels are most important to pay attention to. Thereafter, we're going to take a look at some of our big tech names. Same thing. Where am I possibly looking to take some trades on some of our favorite big tech names? Because I do believe that there will be more volatility in the market, and more volatility means more opportunity, provided we are more patient as well. And lastly, guys, we're going to take a look at our portfolio rundown for all the trades made in the week, recap a lot of the profits that we had this week as well, and lastly, go over some of the trades that I remain into next week as well. So a lot to cover in today's video, guys. Should be very interesting. Should be a video that is going to be very important for a lot of you to kind of internalize what's happening in the markets right now and make a conclusive decision as to how you want to handle the current volatility in the markets. So all that being said, let's jump right into the action, shall we? So the SPY down about 1.53%, the QQ's down 1.57%, and all across the board, well, it is very reminiscent of what we've been having since Jerome Powell. A whole bunch of red in the markets. Not much of names were saved in the markets. Walmart, Costco, Meta, Eli Lilly, and a few key names in energy and utilities only. The rest of the market, bright red. Put this on a 1 week relative performance, guys. You'll see largely the same picture. We do have some outperformance here and there, but largely more so than not, a lot more names have been down than up. When you put on a 1 month, you will see the damage that has been done since Jerome Powell. Almost the entire market, guys, ending the month, 1 month relative, of course, in the red. Put this on the 1 day relative in terms of group performance. You can see only energy etching out some gains, but on the Friday session, everything deep in the red, led to the downside by financials, real estate, and technology, a byproduct of your rising yields. And we will definitely be talking about yields in a few short minutes. 1 week relative remains also quite weak. Energy and healthcare, the only two green. Everything else to the downside led to some of your interest rate sensitive sectors, such as real estate and financials. And the 1 month relative, as we've been saying, guys, pretty much everything now deep in the red. Some names, some sectors less than others, but for the majority, a lot of your interest rate sensitive plays have been significantly down. So before we get into more technical analysis, guys, let us dive into exactly what is happening in the markets. Why, when we get a beautiful jobs report, and trust me, it was a very nice jobs report on the Friday session, coming in non-farm payrolls, 256,000 jobs added to the public sector in relation to the 260K expected. Now, I hear your concerns behind the screen, guys. You might think, yeah, well, a lot of that was seasonal jobs for seasonal hiring for the most important period of the year. Yes, and I do agree, guys, but what would you prefer the flip side to be? Would you prefer this number to be significantly negative or losing jobs in the busiest period of the year? That would tell you that nobody is shopping, that institutions, or rather corporations, are worried about dwindling profits and dwindling sales, and as a byproduct are not hiring. We did not get that. It showed that Q4 was a very strong seasonal period and that hiring was required to keep up with the demand. So you would be very hard pressed to pick apart this jobs report, because all in all, it was very good. Whether you look at the mid-year point or the 12-year running mark, Everything was good in terms of unemployment. The unemployment rate down from the 4.2 expected to about 4.1, which all in all is very close to the historical normal average rate of unemployment. So after such good news, why is the market down? Same thing as Wednesday, guys, when we got Tuesday, when we got the JOLTS jobs openings report that showed that there's more jobs available in the economy than there was in the past few months. These two things, very bullish news reports for the market. However, the market is now in a tale of between two narratives, where good news is now bad news for the market. We have seen this play out many times over 2023 and 2024 alike, whereby the markets want one of two things. They cannot have both. You either want interest rate cuts in a rapid fashion, which is what you're seeing right now. All of this since Jerome Powell has been some sort of an interest rate temper tantrum, whereby the Federal Reserve has reduced its amount of possible rate cuts for the foreseeable future. You can see that right here in terms of the federal funds rate, of course. The September projection was for 3.4% by the end of 2025. They've put it up to 3.9. So we've went from 4 cuts to 2 cuts possibly. That is one of the reasons that the market is not liking it right now. And of course, as a result, you've been having some slides and some downside volatility. So the market is having a temper tantrum in terms of not getting the interest rate cuts that it wants. But then again, guys, what is the flip side? You have to ask yourself, what is the flip side, right? Well, the flip side is all of this jobs data comes in extremely negative and points to a recession scenario. So what do you want right now? The lesser of two evils, right? Do you want somewhat sticky inflation and higher rates for longer, although the median wage growth is above the rate of inflation, which is very important to look at? People are earning more money than the rate of inflation is going up. So you are regaining purchasing power right now. That is good for the economy. Strong jobs reports are also good for the economy. So I will ask you the question again. What would the market prefer, or what would the market least want? The market, in all reality, would least want the jobs to be falling off a cliff, the economic production to be falling off a cliff, and us to go into a deep form recession. They would not like that. The markets would be a lot lower than right now. So what you're having right now is a market that, by all means and by far and by large, they're happy with the direction of the economy. They're just not getting the amount of interest rate cuts that they want, right? But we're definitely not having any recessionary data, which would be the worst of the two cases of scenarios. So before we get into the technicals, guys, let us go over the big list that I've put together for today's video in terms of the pros and the cons and what we have to be expecting later on in the month of January. We're going to do a full recap, then I'll give my conclusions as to how we can best position for this. And this is going to be somewhat of an institutional level analysis in terms of pros, cons, the volatility catalyst to look out for, and lastly, the conclusion as to how we can best position for trade. So, number one, the pros in the markets right now, guys. Well, number one, the economy is definitely still strong. The GDP number is still strong, 2.8% for 2024. That is excessively strong, and when we look to the Fed's projections for 2025, we do not see any sign of a recession whatsoever. They do still see GDP at roughly above 2%. That is very good. The wage growth as well is above the somewhat climbing inflation rate that we've seen in the past 2-3 months. Wage growth right now is about 3.8, 3.9% year over year, and inflation is sticky between 2.5 and 2.8, depending on which inflation measure you choose to use. So consumers are healthier than not right now. It may not feel like it, but that is definitely what the data says. Number two, Powell did say he is optimistic for 2025, even despite the market reaction to his labor and inflation comments. Speaking about the meeting back on December 18th, this massive red candle, he did say he is confident about the direction of the economy and the labor market. However, his comments on the uncertainty surrounding these two factors is really what unraveled the markets and has been plaguing the markets ever since. Number three, the jobs market is not yet unraveling. We saw that this month and we saw that last month as well, guys. Jobs numbers are fairly strong, both when you measure new job openings and the amount of jobs that have been created. Now, number four, SPY EPS is still supposed to grow at 12 to 15%. This is definitely not a recessionary outlook by some of the largest players in the entire stock market right now. You can see that by the data compiled by FactSet, brand new report released January the 3rd. FactSet is one of your leading institutional data providers. So when they say something, guys, they have a lot of data to back it up. Earnings growth of 14.8% and revenue growth of almost 6% for calendar year 2025. Forward 12-month PE ratio is about 21.4 for the SPY, slightly above the historical average of 19.7. So we do still have growth in the stock market. At least that is the projection for 2025. That is a big pro. We're not guiding for DPS being crushed and profits being crushed. Not yet, at least. Now, before last, semiconductor and AI growth outlook is extremely strong. Every single one of the semiconductors, the large players in the market, over the last quarter have said the AI trade is definitely not dead. We've heard that from all the largest players, and so the semiconductor trade and AI growth outlook is still fairly good. So that narrative does remain strong into 2025. And lastly, in terms of technicals, we do still have the monthly uptrends, arguably the most important uptrends of them all, and we do still have them across the SPY, the QQQs, and many other sectors alike. That is it for the pros. Now let's dive into the cons, right? The cons is a technical breakdown of the daily and weekly timeframes and uncertainty, speculation around inflation and interest rates. And yes, I put the emphasis here, guys, on speculation. The current sell-off that we're seeing in the market is all based around speculation, largely around speculation surrounding Trump's new policies when he comes into office. Nothing is certain for now. Everything that we're seeing is entirely speculation, because the actual hard data that we're getting is that the economy is still strong. But right now, a lot of uncertainty, speculation, and I keep saying it, guys, what the market does not like is uncertainty, right? You can tell when the market is certain of something, it has no problem rallying, but throw in some uncertainty surrounding actual factual data. The sell-off we had in August was because the jobs numbers and manufacturing numbers were coming down significantly and inflation was still sticky. We do not have those same concerns right now. The concerns right now are all speculative in their nature. Now, number one, the reaction of NVIDIA selling off after the CES event. Now, you guys remember, we covered this a little bit when it happened. NVIDIA had an actually beautiful CES presentation by Jensen Huang. All of the products were looking fantastic, and the growth outlook for the business, especially in terms of going into the software business for a new sales vertical, was extremely strong. How did the market react to it? Sold the stock down from the highs 8%, guys. That is what lets you know that the market is in a very timid environment right now, refusing to even give credit to NVIDIA for that, just selling the stock down first thing after the morning after the open of CES, right? So that was one thing that I noticed that told me, oops, we need to take a little bit of a step back here because nothing is being rewarded right now. Everything is being temporarily rewarded and then just sold off the very next day. Number two, Bitcoin head and shoulders and SPY and head and shoulders as well. Well, I have the SPY right here. The head and shoulders is clear as day, guys. When you have so much uncertainty in the markets right now and you have a massive head and shoulders pattern on the daily like this, the odds of the follow through get higher and higher because of the uncertain market environment. It would be one thing if just a few key stocks were putting in head and shoulders pattern and the SPY and the QQQ were rallying to all-time highs. Then you can kind of discount the head and shoulders pattern on individual names. But when the SPY and one of the most risk-on trades that you can possibly see are both putting on head and shoulders patterns, you have to pay attention to that, guys. It shows a technical breakdown and a lack of upside momentum. Now, number three, the Trump tone shift from November until now. When Trump was elected into office, you can see the massive pop that we had on the markets, and the bullishness lasted right up until Powell, when Powell finally commented him and several other Fed members after him when they slightly hinted at the fact that they raised the inflation projections from 2.2 from the September meeting to 2.5 in the December meeting. This, when asked upon why, it all had to do with possible tariffs incoming from the Trump administration. So the tone has now shifted from one of utmost bullishness to one of more uncertainty surrounding the political landscape in the next few months. So that is definitely a tone shift, and we need to pay attention. This was a pure risk-on move, and now with the uncertainty that Powell threw upon us and several other Fed members and analysts alike, now we have an uncertain tone shift from pure bullishness to now risk off. Now, thereafter, we do have bank earnings amid higher for longer rates. Now that the Fed has pretty much cut the expectation of 4 interest rate cuts down to now 2 for 2025, it's going to put a lot of pressure on bank earnings because the most watched metric in there is going to be net interest income. And it stands to argue if the longer term rate yields are going to be higher for longer, especially the 10 and 20-year yields, which are associated with financing for car loans, financing for home mortgages, and a myriad of other things in between, it stands to argue that people will be taking out less loans. The banks, because of the previous Federal Reserve bullish guidance for interest rates, 4 cuts, even maybe 5 cuts, the banks last quarter said that 2025 should be fairly good and that their net interest income should be coming higher. Now, with the revision by the Federal Reserve, Are the banks possibly going to reduce their guidance? That would not be good for the financial sector as a whole, and the financial sector being one of the leading sectors in terms of weight in the SPY, that could contribute to the sector coming down and pulling down the SPY as well. Moving on further, the yields. The yields used to be a speculative rally. Now it is real. It is repricing like they did earlier in 2024. When we get the inflation scares, guys, you guys know what happens to the yields, right? The last time we got an inflation scare, a big one, was of course the fall of 2023. We had another one coming into April when we kind of unraveled a little bit with 2-3 inflation reports hotter than expected in a row. And you will see how the yields react every time we get higher than expected inflation numbers. They do not like it, guys. Here is the April rally in your 20-year yield. Here is the one from fall of 2023. And now you're seeing, since the Fed cut interest rates, the market did not believe them. They did not believe that the inflation problem was solved, and as such started bidding up the yields on the 10 and 20-year yields respectively, right? So that being said, this is a problem for the markets. It is a counteracting force. The SPY, the QQQ, the risk-on trades do not like it, guys. Why? Well, because equities have to compete with rising yields in bonds. Bonds are known as what's called to be the risk-free trade, right? Obviously, there is a risk of the U.S. government defaulting, but it's a very small risk. So would you rather park your money, if you're an institution that has tens of billions of dollars, would you rather park your money in a 10 to 20 year bond that pays almost 5%, which is very good? It's half the average S&P performance, right, per on a yearly basis. Would you rather park your money there or park your money in an equities landscape with arguably deteriorating uncertainty? So that is what's known as, it used to be a speculative move. When Powell first started cutting rates, people thought it was just funny that yields were rising. They were saying, oh, it's just temporary. Now that we're above 5% and the inflation concerns are real and the uncertainty is real, now people are paying attention, aren't they? Now, number 6, loss of the bullish sentiment. Speculation risk on trade has been unwound, and the loss of the weekly index uptrends. As I'll get into in a few short moments, we now have a loss of the weekly uptrends. We have not had a loss of weekly uptrends, guys, since fall of 2023 on the SPY. Same thing for the QQQs, and you guys have seen all of these speculative momentum trades unravel one after the other. Jensen Huang pretty much single-handedly killed the quantum computing trade just last week. Here's IONQ. Here is Qubit as well, was massively down, right? As you guys can see, massively down. Here is another one that people love to play, Rigetti Computing, but it does not stop there. Here's one of the hype AI trades, SoundHound, that everybody loved buying up here. People thought that it was the next Palantir. Now, reality check, down about 50% in 2 short weeks. The other one, of course, is Palantir. Everybody loved buying Palantir in the 75-80 range, layering up on the call options, and now Palantir with its first daily downtrend in a significant amount of time as well. And the list just goes on, guys, of all the bullish trades being unwound one after the other. Bitcoin also has started to be unwound as well. So you need to pay attention when you see this shift from risk on to risk off. Everybody who was super bullish here on Wall Street Bets, on Reddit, wherever you were watching, all the YouTubers pumping all the hot stocks, they have all changed their tone in the last week, haven't they? You have to pay attention, guys. The liquidity in the markets is very quickly drying up. Retail is not willing to buy these dips as aggressively as they were just a few short weeks ago. Now, number 6, or 7 rather, the tech earnings. The profits and the layoffs will be front and center for the tech earnings coming up in about 2 short weeks' time, because tech is supposed to carry the markets in 2025 because the higher than expected yields. The big tech trade was a very popular trade all throughout 2023 and 2024. It has been the market leader, and a lot of people have criticized the market for being too top heavy. Why was the market top heavy? Because these companies are the most cash-rich companies in the world. They have pricing power, they have monopolies, and arguably they do not really care what interest rates are because they have the dominant pricing power. They have a ton of free cash flow. They have a ton of cash on the balance sheet. So that being said, these are some of the best positioned companies to weather a higher for longer interest rate campaign. Now, I'm not saying these companies cannot go down. I'm just saying they probably can go down less than some sectors that are highly sensitive to interest rates. So a lot of emphasis will be on the big tech earnings, guys, because they are supposed to be the most favored trade in 2025 because not only of the high yields, but also the AI popular narrative behind them. So those are the pros, those are the cons. Now, the volatility catalyst, guys, for January. I've said this since Powell, right? I said that be careful during January. I hinted at this during the Christmas break as well. I said, be very careful because the volatility will be high. And if the market is going to choose to use all of these news releases as excuses to dump the markets, create the fear, bring in the volatility, they have all the fuel to add to the fire that they want in the month of January, right? All the fuel that they possibly want. They just had two catalysts that they used to drop the markets, as you saw. This next week, January 13 to 17, CPI and PPI. If those come in even slightly hotter than expected, especially in terms of this market narrative, what do you guys think is going to happen? Will you guys think we're going to fill the gap down here and follow through with the head and shoulders? Probably, right? Now, that being said, retail sales as well for the biggest month of the entire year where people go shopping the most in December. Retail sales this upcoming week is going to be absolutely massive. And we get a start to the banking earnings, which we have to pay attention to because that could be a con in the market. All the banking earnings starting on Wednesday, JP Morgan, Citi, Wells Fargo, BlackRock, continuing on Thursday, TSMC as well, Goldman Sachs, Bank of America, Morgan Stanley. You guys are getting the point right about now, right? All the volatility catalysts in the world for the market to run with them one direction or the other. January 2024. Now, Trump inauguration and GDP, two more very big volatility catalysts. When we start to get initial Trump policies, how is the market going to react to them? We don't know. I don't have a crystal ball. All I'm saying is that it is a massive volatility catalyst for the market. January 27th to January 31st. Well, I'm glad you asked. All of the big tech earnings except for Google, and a Powell potential pause on January 29th with another FOMC meeting. And on the Friday, January PCE, another inflation report for the markets. Now, the Powell pause is a real thing. Here's the probabilities of the Powell pause. It is currently standing at 93.6% odds that the Fed is going to pause in the January meeting. And the next meeting is all the way up until March, which currently remains somewhat largely of a coin toss, but a little bit more of a penchant for a pause there as well. So those are your volatility catalysts. Those are the pros. Those are the cons. As you can see, there is a large number of factors that can affect the market to the downside in the month of January. They have all the excuses that they want in the world to bring these markets down a little bit more, create even more fear catalysts for us. So as traders and investors, what are we supposed to do? This is why I put the conclusion on this page, because if I would have put it on the bottom of this page, you guys wouldn't read any of this. You would just read the conclusion. So now that we've kind of went over these points, what is the conclusive evidence? So conclusion is, you have a decision to make. I cannot make the decision for you guys. And I'm not going to start providing financial advice as to what every person should do. Everyone has different risk tolerance. Everybody has different portfolio goals. Everybody's at a different stage in their life. But you have a decision to make right now, guys. You either ride the volatility and everything that goes with it, and act like nothing happened, because we can see a clear shift in the market tone right now since Powell, and I've been talking about it for a month at this point. You can ride the volatility and act like nothing happened, or you can recognize the current narrative at hand. You can trim covered calls as well and possibly wait. This is what I'm doing. I am still bullish in the markets. I will give a metaphor that I gave to my Discord as well. Let's say you are driving down the Autobahn in Germany where there's no speed limit, right? Let's say you're driving a nice Porsche with beautiful summer tires, right? Sticky, slick tires on the Porsche. And it's a beautiful sunny day in July on the Autobahn, right? And you're just flying down it, right? Why? Because there's no traffic, the roads are clear, it's sunny outside, and you're just flying maximum speed into the down the highway, right? This is what's known as your bullish momentum markets, where you can literally just put on call options, and provided there's no bad economic data, you should be okay. However, what the market environment is right now is now you're on the Autobahn, you're in the same exact Porsche with your summer slick tires, but it is raining as hard as you can possibly imagine. The wipers are going like this. You still can barely see anything. Are you still going to be going 300 kilometers an hour, 200 miles an hour down the highway amidst massive rain? Probably not. However, you are still driving forward. However, you are maybe now in the right-hand lane with your 4 flashers on, with the wipers on the maximum, going the actual speed limit or maybe a bit under. This is what I mean, guys. There is times in the market to put your foot full on the gas when you have the opportunity window to do it, but there are other times in the market where we are still driving forward. We can still remain bullishness. However, we're in the right-hand lane with the wipers on, with the 4 flashers on, because we're being cautious, right? So that is the metaphor you should remember right now. And right now, this is me. I am in the right-hand lane because it's raining. I have my wipers on. I have my 4 flashers on, and I'm just taking my foot off of the gas. Does that make sense? So number one, the catalyst. If you want this market to reverse, What is the catalyst to put in new all-time highs? Well, you will quickly understand that the catalyst for the next rally are uncertainty catalyst removals, and these cannot be solved in one day. If the catalyst for a rally is going to be removal of the inflation uncertainty, what has to happen? We have to learn about Trump's policies and their effect on the underlying economy. We will not get that certainty in Trump's first week of the election. No chance. It will require possibly 1 or 2 CPI reports that come in under the expectation and Trump policies that do not hint that inflation will be a problem. That does not go away in the snap of one finger in a one-day candle to the upside, pushing us to new all-time highs, guys. It will take a long process, especially considering that we lost the weekly uptrends. Weekly uptrends takes weeks and weeks and weeks to recover, right? So, number 2, does the market really want rate cuts or a recession? We talked about this earlier. Number 3, valuation matters again. Very funny now that when the markets drop, people start to say, well, Palantir was overvalued, SoundHound was overvalued, SOFI was overvalued, the quantum computing stocks were all overvalued. Now it starts to make sense. A month and a half ago, you tried to tell people that, and they would just say, well, valuation doesn't matter, it's a raging bull market. Well, now valuation matters again. Welcome to the game, right? Number 4, clear risk on to risk off narrative since Powell. I touched upon it after Powell. I said there's a high likelihood that we go into monthly consolidation. After this candle, after uncertainty was planted into the market, here we are. Risk on to risk off narrative. You have a decision to make. Are you going to act as if nothing happened, or are you going to start to manage the risk? And number 4, here you may not agree, and this is very important, you may not agree with the sell-off reason or the narrative. I don't agree with it as well. I think the inflation concerns are largely overblown. I do not think we have any recessionary data, and I do not think Trump's policies are going to be much more than a bargaining tactic towards other nations. However, what you think, guys, is completely irrelevant. The market is never wrong. The market plays off of narratives. It is your job to recognize the narrative. And even if you do not agree with the narrative, even if you think it's BS, which a lot of people think right now, it does not matter. You have to play the narrative for what it is, guys. Recognize it, be objective, and play it as a narrative as it is. You have a decision to make, right? You have to recognize the narrative and decide how to play this narrative, even though you may not agree with it. You have to play it for what it is. If you're going to call the market bluff, such as I'm trying to do, you need to have proper risk management while calling the bluff. You need to have patience, and you need to have very proper trade selection. Not maybe so much the risk on trades anymore, right? Number 2, you want to be carrying the maximum amount of buying power through the end of January. Why? Well, because we're not through it yet, guys. We have all of these volatility catalysts, and every one of those could act as a big catalyst to the downside or upside for the markets. There are going to be some wild swings in the next few weeks. I guarantee it. And then lastly, short-term volatility trades, not so much maybe buy and hold, could be working so much well through February, right? Now is maybe not the time to buy all the call options in the world with a 6-month time horizon, knowing full well that we can drop a little bit more. Short-term quick volatility trades, sure, but the buy and hold trades, we need to be very patient for them, identify levels, and wait for daily oversold conditions. So the moral of the story, what am I doing? I am still cautiously optimistic, but I'm patient and selective. I'm driving in the right-hand lane, my wipers on, my 4 flashers on. I'm still driving forward. I'm still long the markets, but I'm being very patient and very selective. Number 2, we are not overloading the long side on any pops thinking, oh, nice, the market's finally back. Now's probably the time to go for more all-time highs. No, you want to be buying the markets when they're at the low, when the fears are at the high, and when you're seeing daily oversold conditions on stocks that have pulled back to very big weekly support levels. We'll talk a lot about that in a few short minutes too. Number 2, you want to not get trapped at poor levels. This goes with the before point, right? If you are longing here and you get trapped, it is going to hurt. So you do not want to get trapped at poor levels in trades, guys. Be patient. There's so many stocks in the market. There's so many opportunities. You will not get left behind, even if you are a little bit more patient than most people are right now. And lastly, we're not buying long duration calls until big support levels or daily oversold conditions. So you will not be seeing me buying any more call options. I will be playing my favorite strategy, which is writing short puts well under the market into daily oversold conditions and large weekly levels of support. So as a whole, still cautiously optimistic, but I told you, I'm in my Porsche in the right lane, the wipers on, the 4 flashers on, driving forward, but a lot more cautious than we were in the November to early December period, and possibly even from earlier in the periods of the year as well. Now is a time to kind of take your foot off the gas and evaluate build a watch list and strike the companies when they come down to your levels. Do not get overly greedy. Be patient. Let the market come to you. So as a very big introduction, guys, this is the last one of its kind that I'm going to do in the markets. I gave you guys a huge rundown late December after Powell spoke. We went through the entire pros and cons list again. We did it again a week and a half ago at the turn of the new year. I'm doing it again, but this time, guys, I will be referring you to the start of this video in all future videos next week, because doing this every single video is very time consuming as well. So I figured I should give you guys this analysis once and for all, and then you guys are free to do what you want through the month of volatility. As I said, you have a choice to make. You can either ride the volatility and act like nothing happened, or you can possibly trim, exercise a little bit more caution, and wait for better levels and better entry prices. I personally will be doing the latter, which is why I freed up so much buying power, guys. I have maximum buying power on the sidelines for these January and early February dips. If we get them, I will be very happy to be going shopping. And there's nothing that feels better, guys, than going into some of these corrections and consolidations with maximum buying power. You are just protecting your hard-earned money, right? So that being said, that is your introduction for today. Hopefully you guys appreciated that. Now let's dive into some of the juicy stuff, which is going to be the technical levels, of course. And we're going to start off with a full index rundown. I'll run through these a little bit quickly because by now you guys should know the expectation, right? Or you should know the overall direction of the markets. So that being said, we are right now at a loss. Daily downtrend is clear as day, and we have now flushed the lows of Powell and flushed the previous lows as well, 581. So daily downtrend right now on the SPY is clear as day. Yes, we are into support, but keep in mind the gap fill 575. Do you guys think with a head and shoulders pattern that looks like this? I mean, I drew it a little bit off, but head and shoulders pattern like this, right? Below the moving averages, low momentum. Do you guys think we have a better probability of filling the gap now that we're so close? Or you think we're just going to reverse from here and put in new all-time highs? Most likely, we are going to fill this gap at 475, maybe even as early as next week. So pay attention to that. Not even daily oversold conditions at all yet on the SPY. So even though it feels like there's been a lot of pain, guys, not even close. Not even daily oversold conditions. The last time we had those was the bottom of the sell-off in the month of August. So please pay special attention as well. We have lost a big one, guys. This is a weekly downtrend. Usually when you get weekly downtrends, they do not solve themselves in one single week. This weekly downtrend could lead us into possibly the lower area of support, 565 down to about 551, which is the previous highs before the August sell-off. That would be a combined top to bottom drop on the SPY of 7 to 8.5%, largely the same percentages that we got on that August sell-off as well, when there were similar fear catalysts in the market. So pay attention to that. Weekly downtrend also means that we are in monthly consolidation. And I said this after Powell. I said I would not be surprised if we go into monthly consolidation. The chart wouldn't even be surprising as well, right? Here is your monthly uptrend. If we consolidate all of January, early February, and come down here, line up with the 12 EMA, set a monthly higher low, and then rally March, April, May, would anybody feel weird about that? Would this chart look bad? No, but we will have this monthly consolidation underway. It is a perfectly normal form for the markets. And I will remind you of the seasonality. Look at January and February, very volatile months. If they're going to choose to hit the monthly consolidation levels, they will do it in the month of January. Why? Well, because they have all of the catalysts in the world to possibly do this, guys. So now is the time that they can do it, and most likely will do it if all of those events are not well received by the market. So please keep that in mind. In terms of our momentum indicators or how much percentage of stocks are above, I will remind you, fear and greed index is at fear. You might say it's time to buy the dip, and I do agree, but we have to be very patient. I want to see even more fear, guys. I want to see extreme fear reads. We do have extreme fear reads on a few things. The 125 moving day average, we're pulling down hard into it, showing extreme fear for momentum. Stock price strength, net new 52-week highs and lows on the New York Stock Exchange. You can see we're at the lowest point, arguably, of all year so far. Nothing is going up. Everything is hitting new 52-week lows, extreme fear conditions there. And stock price breadth, we're going to look at this, but we know the market has not been broad at all. It has been the everything sell-off. So yes, we do have a lot of fear catalysts right now, but not extreme fear just yet. Leads us to believe that this can oscillate between fear and extreme fear as they continue dropping the levels for this monthly consolidation. So I am being patient. I'm building a shopping list and a watch list of stocks that I want to own if this gets a little bit worse. As you can see here, percentage of stocks above their 20-day moving average. Take a look here, guys. Quickly erased all the progress that we made early on last week, right? Now, 26% of all stocks are above their 20-day moving average. It's low, but it can get worse. It can go all the way down to the teens. We've seen this when? After Powell, we've seen this in the August sell-off, culminating with the Japanese carry trade. We saw this in April. Notice the common themes here. And the last time we saw this was the fall sell-off of 2023. So can it go lower? Yes. So pay special attention to this. Percentage of stocks above their 50-day moving average, 28% only of all stocks are above their 50-day moving average. Can it get worse? As a matter of fact, yes, it can. It got worse in the fall of 2023. We are clipping into lower levels, imagine it or not, lower levels than we had in August and even the April sell-off, when we were having inflation concerns and economic concerns as well. So this can come a little bit lower, even though we are coming into buy the dip territory all across the board. It can go lower. I'm not calling a bottom, guys. I'm calling this a slow but warranted bottoming out process, not a direct level where I say buy, 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 buy. It is a bottoming out process, and these bottoming out processes take some time. Percentage of stocks above their 200-day moving average, same concept, 46% only of all stocks above their 200-day. This can definitely go lower. We are at the August lows, but you can see when it gets really bad, such as fall of 2023, we can go a significantly amount lower. So short term, are we oversold? 20% of stocks below their 20? Yes. Are we short-term oversold on the percentage of stocks below their 50? Yes. But when you take a look at the longer-term moving averages, no. So essentially what I'm saying is you can have a whole lot of this. You can go higher and then just grind lower, and that will progressively bring the percentage of stocks above their 200-day lower and lower and lower. So do not get fooled with short-term pumps in the market. They can, as we've seen, guys, they can quickly get eroded as early as they were here to begin with. A bounce is very nice, but unless a bounce translates into a new daily uptrend, all it is a lower high for a low, for a lower high, for a lower low. You need to see the bulls put their butts in gear, but as of right now, no requirement to set the daily uptrends by the bulls. We'll keep an eye on them closely. QQQs now, this will be a lot quicker moving forward. Daily downtrend in motion. Flush of the lows right here, 509.31. We are now below the support level, below the moving averages as well. Not looking the best for the Qs. Daily downtrend means you're also in weekly consolidation, but more than that, we closed the weekly level below the lows, 507.21. Below the Powell candle as well. Welcome to weekly downtrends in the Qs. We have not had weekly downtrends in the Qs since the month of March into April, when we had these very same inflation concerns. If the weekly downtrend progresses, where are we heading? Down here, 500 down to about 495 is the next stop. Prior highs of the month of August before the sell-off, and a few little resistance, which are now going to be support points as well with the 26 EMA. So keep in mind for that, guys, if you do drop that lower level, that will be QQQ down roughly 7 to about 8% from the all-time highs. Usually a decent opportunity to start buying the dip, but can it go lower? Of course it can go lower, guys. This sell-off in the month of August took us down all the way 15%, but it is a good opportunity to start buying here and progressively be buying throughout this range right down there. Absolutely, guys, and that's what I'll be doing, but very, very slowly. Moving on to XLF financials right now, well, you can see the damage that was done because of rising yields on Friday. Now, new daily downtrend established by financials. They have earnings coming up this week, so going to be tough to derive short-term price action levels for an entire index that has all of its earnings this week. Obviously, if they reduce their guidance for net interest income, we are coming down to the Trump election gap fill, which is all the way down here, Tuesday, November the 5th, coming into 46.54. Now, usually financials is not Palantir. Whenever you have a big gap on the financials index as a whole, usually they have a high probability of being filled, especially when we're being so close to it. So that being said, daily downtrend can continue. If we get a bounce, we're only looking for a lower high. Anything below 49, looking for a lower high into possibly lower low into earnings. We'll see how they react to earnings. But the next support level below us, since we're challenging this one, is all the way down here, 46 down to about 45.35. We'll take a look at how they set that up. Weekly downtrend as well, guys. Lower high, lower low. That is weekly downtrend. We have not had a weekly downtrend on financials in how long? Since the fall of 2023. It's been a very long time, guys. A year and a half, no weekly downtrend. Now they're in motion, so you guys know the drill. Weekly downtrend means monthly consolidation is now underway. Good thing for the bulls. They have a lot of space here. Anything pretty much above 39. Going to be looking for a monthly higher low for further trend continuation. So my question to you is, if financials has a poor month of January, look at this candle close in December. If financials has a poor candle close in January as well, and early February, and we come down and we touch the 12 EMA, and then put together a rally when the market recovers from all this, March, April, May, June, in line with seasonality as well, right? Would this chart look so awkward? If we have a time machine and come out here, and we are actually up after that, would this dip look so awkward? No, it would just look like normal monthly higher lows, right? So keep that in mind. This is monthly consolidation for the markets. Look at the SPY, look at the QQQs. rolling over as well on the monthly. Look at the XLF. You have to pay attention to the longer time frames, guys. The bulls have lost the dailies, they've lost the weeklies, and now we're into monthly consolidation. And I've told you once, I'll tell you a million times, monthly consolidation and weekly downtrends do not turn around in the snap of a finger. It does not happen. It takes weeks and weeks and weeks to turn these charts around to the bull side, right? So you will have time, and you will have time to put on the trades that you want to put on. Don't get impatient with the markets, guys. Don't think you have to buy the dips every single day it's red, right? Be patient, establish some levels, wait for the market to come to you. And even if it doesn't, guys, you will have so much time. I mean, you know how long it takes to reset these daily uptrends? A long time. You know how long it takes to reset these weekly uptrends, right? A very long time, right? You can see it here. How long did it take to get back above the August flush? It literally took 2 months, guys. You will have ample opportunities to go shopping, so just keep that in mind. XLV healthcare right now, healthcare remaining a little bit weak, even though we do control the daily uptrend right now. The market's overall not looking too hot, and obviously Trump coming into office in 2 short weeks' time puts a lot of pressure on the healthcare sector because we know he's going to be reforming policies, him and RFK Jr. That being said, weekly downtrend is in motion right now. Look at the size of this bounce on healthcare. Healthy bounce? Not quite. 50% bounce. 50-50 chances of it giving the bulls an opportunity to reset the weekly uptrend, or 50% chances for the flush towards lower lows. The way the markets are shaping up right now, I would not be surprised if it's going to be the latter. Maybe even looking to push on for lower lows. That would be a flush of 135.39. Good thing on the monthly, guys. Well, the monthly, we've now unraveled. It's given back the entire monthly uptrend as a whole and flushed the monthly lows. So to recapture this monthly uptrend is going to take months and months and months. So no rush, in my opinion, for the healthcare sector. That being said, this entire area we're coming into is going to be support, previous resistance, new support, culminating in the 50 monthly moving average at 130. So pay special attention to healthcare. I am in no rush to play this sector with the volatility catalysts on the horizon for the next 2 weeks, leading into Trump's inauguration. Moving into semiconductors right now, semiconductors down 2% on the Friday session, still in the context of a daily uptrend, but not looking so good. We gave back all the momentum, and just goes to show that, right, this weekly resistance has been very, very troublesome for the markets. 260 down to 250. Once again, we could not close above and clear, and now we are right back down into the gulag, right back down into this very tight range of price action, trapped between 2 levels, trapped between overhead resistance and below support down here. Now, this week we do have TSMC earnings coming up, so we'll see what their guidance is. But if their guidance was in line with the rest of the sector, what they've been saying the last quarter, guys, they should have beautiful guidance for 2025. But with the market sentiment right now, is the market going to care? One thing's for sure, I do believe TSMC is going to crush it. But you guys have seen what's happened. Companies can crush it, and if the market sentiment is not favorable, they may not get the lift that you're looking for, and the bullishness may not carry into the other semiconductor trades. So we will see if they have it in them to continue this daily uptrend and try to make an attempt at capturing this resistance level, or whether or not we get put right back down here. I don't mind either case scenario, guys. If we come back down here, I will be writing short puts under the market on my favorite companies. Moving into the Russell right now, the Russell also very weak, well, because of the rallying yields and the move from the risk on to risk off trade. That is exactly why I cut this trade the day after Powell. It did not make sense to be in this trade if the risk on was shifting to risk off and if yields were going to continue embarking on their rise. That being said, it was a daily uptrend, and now we have flush. So we've now lost this, equal highs arguably. So now new daily downtrend touching the 200-day EMA, but that's not going to stop the bears. In my opinion, weekly downtrend is now in motion. All the way down here, 208 is the final location for your support level. And on the monthly time frame, guys, you can see, right? This is the creation of a massive supply zone. Not the best look for the markets as a whole. And monthly, yes, we are in a monthly uptrend, but I would not be surprised if monthly consolidation continues a little bit lower, coming down maybe 208, down about 205. We will revisit this trade when we come to it, but as of right now, I'm just not interested in the Russell at all. It is not looking the best. The momentum has been lost, and in the face of rising yields, I do not think that this is the smartest trade to be into unless you're trying to speculate and pick the top of yields and build a longer term position that you do not mind holding through the volatility. Right now may just not be the best time for that. And now lastly, the Dow Jones also breaking down below, daily downtrend clear as day, almost flushing through the last line of defense right here, which is 41,900. We will see if ever they come back a little bit lower than that. The 200 daily moving average is down here, 41,175 roughly. So daily downtrend underway. They could not convert into the daily uptrend. The crush in value stock simply continues because they are competing with the risk-free rate being 5% right now. And when value companies don't grow their revenue a whole lot per year, and the best they can offer largely is a dividend payment of 3 to 5%. And then on the other hand, I offer you risk-free bonds that are also paying roughly 5%. If you're an institution, which one are you going to take? You're going to take the low growth value names, or you're going to take the risk-free trade, which is bonds? Well, obviously you're going to take bonds, right? So moving into the weekly downtrend is now set in motion. We know that weekly downtrends equate to monthly consolidation periods, and that is one thing for sure, right? Monthly uptrend is very nice, but we are due for some monthly consolidation. Culmination probably level is down here, 41,000. We'll see how they react to that when they get to there, but a lot of space, anything above 37.7, looking for those monthly higher lows. So the bulls do control the larger monthly time frame. So you can see all across the board, we've lost the dailies. We never really had the dailies on the Dow since all the way back here. But we have lost the weeklies as well. And that is something that you have to pay attention to, guys. You can't let these things fly above your head and just keep buying the dips as if nothing happened, right? Weekly downtrends and monthly consolidation periods can take just that. They can take weeks or maybe up to a month to possibly reverse and find a local bottom. Now, moving into some of our minor sectors, the ones that are also being affected by interest rates right now, you can see very clearly as well. Same concept, the SPY, as everything else, right? Weekly, unfortunately, equal highs and lower lows means this is a new weekly downtrend for XLP. So all your consumer defensive stocks, well, most of them, other than Costco and Walmart, everything else taking an absolute beating. And I would not be surprised. Usually the leaders of a sector are last to fall. When you start seeing Walmart and Costco start falling, and they have started to fall a little bit, right? Walmart is slightly off its highs. Costco as well is slightly off its highs. I wouldn't be surprised if more pain is going to come to the sector. And overall, we are in for monthly consolidation right now. Monthly consolidation, you can also argue it's somewhat of a monthly downtrend. All I'm saying here is I would not be surprised if we do a glorious breakout, a retest of the prior resistance all-time highs for about a year and a half, which would be $73.5 down to about $70. So consumer discretionary also has more room to fall. There is not much support to be had before this big level, so keep your attention on that one. Utilities, another very interest rate sensitive sector. Why? Utilities companies are not known to grow their revenue that fast. The best they have going for them is a decent dividend, but in the face of a risk-free yield of 5%, that dividend holds less and less weight. At least that's how the institutions think, right? So weekly, not quite a weekly downtrend. We will see if they persist on that road to the downside. Monthly, of course, does need a little bit of a pullback. It is a very nice monthly uptrend right now. Anything at this point above 66 is going to be looking for a monthly higher low for further trend continuation, but pay special attention. We can come down here, 75 down to about 71. This is going to be the reaction zone where we need the bulls to start playing a little bit of defense. If not, we're going to come very, very quickly into our previous monthly tops. Utilities, not looking the best and not one of the sectors that I'd be looking to get into in an environment where the rates are supposed to be higher for longer and where we might only get 2 interest rate cuts the entire year. And into real estate as well. Real estate, same concept. It's all because of yields. The entire market right now is arguably because of yields. That being said, weekly downtrend on XLRE as well. You can see a common theme here. Every single major sector of the S&P, guys, is currently in weekly downtrends and monthly consolidation. You will not be able to snap your fingers and put all of these back into weekly uptrends. That's not how price action works. It takes some time and it takes a lot of money to reverse these timeframes, and it takes uncertainty to be lifted out of the markets. Also something that cannot be done in one single week. As you can see, we are now almost breaking down below our level right now, and big monthly consolidation. Good thing for them. It is a monthly uptrend, but the monthly higher lows are down here, 34.79, looking for a monthly higher low. Last line of defense right now before we pull into the next line of defense, 38 down to roughly $36. So the bulls can lose a little bit more ground until these yields keep spiking, until the yields find an actual ceiling and start cooling off. Now, lastly, energy. Energy has been a favorable trade over the last couple of weeks, as some worries about inflation come back, of course. A lot of speculation in this sector, but I would not say this sector has any clearly defined trend, right? They had the weekly uptrend, lost it, and now it takes a long time for the bulls to get this one back. That being said, the sector is holding up better than some. Still not one of my favorite trades in the market. However, if we look at oil seasonality, that's not oil seasonality. This is oil seasonality. If you look for oil seasonality, you will notice that, as I was saying, I was not a fan of the oil trade late October, November, and mid-December. But you can see since the midpoint of December and even into January, February, and then March, that's when oil starts to come alive. So it could be an interesting trade. I don't really like trading commodity trades myself, but if you are looking to trade these, you are coming into some form of bullish seasonality as we get into the month of February. So that could be interesting in itself. That is everything for your major sector rundown. Now let's take a look at some of the ones that we don't look at that often. The VIX, As I was saying after Powell, I would not be surprised if the VIX remains in a slightly heightened state of volatility, which has been the case, right? A non-heightened state of volatility is down here 15 and lower. Now we've been oscillating between roughly 16 and 20 for the last couple of weeks since Powell, and I do think that will continue through the month of January. Now, I'm not saying I am buying the VIX. I do not like buying the VIX, but if we get some crazy spikes in the VIX, I will be looking to short the VIX because that's usually a very high probability trade. It cannot stay between levels of 30 and 35 forever, and usually when you clip the tops here, could have a decent little rundown for some VIX shorts. That being said, taking a look at yields, we've touched upon yields a lot in this video without bringing up the chart, but I want you guys to realize, right? Does this look like a chart that you want to short right now? Where's the conditions for shorting, guys? There are none. It is a weekly uptrend. We have now lost the monthly downtrends as well, right? We've eclipsed the tops. So I just want you to realize that until we get a significant downtrend, it is going to take weeks and weeks and weeks, if at all. That being said, daily uptrend is also clear as day. So why would you be shorting yields up here? AKA, why would you be longing TLT down here, trying to perpetually catch the bottom of a falling knife that does not have any local bottom in sight just yet? You would rather wait for a temporary topping out in yields, daily downtrend, and then you enter here, stop loss goes below there, and then you target your levels of expansion to the downside, similar to TLT. If we're looking to take a TLT trade, why are we picking the bottoms, guys? Why are we catching the falling knives? It doesn't make sense. You'd rather wait for the daily uptrend, entry goes here upon confirmation of the uptrend, stop goes below there, and then you target your local highs that you're looking to expand. It makes a lot more sense. You have a clearly defined stop loss level, and at least you know you have some bullish uptrends, at least the smaller ones, in your favor for a little bit of a reversal trade. So that is the status of yields right now. They could stay higher for longer, and they could, even though we can drop a level here, guys, right? Doesn't mean that we're going to do this, right? We can very easily cut the highs and then just remain in a heightened status of yields for the next couple of months, similar to what happened back here. Yes, we did drop, but we stayed heightened for a while, for about a month and a half, before we actually started dropping the levels in a meaningful fashion. Same thing as we had back here in April. Look how sticky it was. It was trending down, but not as down as quickly as people have liked to see. So be careful on the bond trades, guys. I'm not saying I'm not a fan of building a bond trade, but you have to extend your duration. If you know yields are going to be higher for longer and you do not know what's going to happen with inflation, well, you can't be buying 1 to 2 month call options on TLT or loading the boat on TMF just yet. You have to extend your time horizon to at least the next 6 to 18 months. 6 is on the short end, guys. If I had any call options to be doing on TLT, I would be going minimum December 2025 and being fairly cautious on my positioning there as well, averaging into it over time, not blowing the entire stack right now. So that's the case in point for this. This, another one, gold, is going to be a very interesting trade. Rising yields, rising inflation, growing concerns in the market. That is usually when the gold trade does come alive. You can see it started coming alive in August when the market started dying and never really reversed from there. It's been forming a very beautiful tightening range, recapturing the 12 EMA, and the bulls look like they want to go for the daily uptrend shift after some form of a bull flag. It's looking very nice on the weekly and the monthly after a few months of consolidation. I'll remind you, this is the consolidation period SPY, QQQ, and everything else is going into. Gold has already done it and now might be looking to put in an extra leg higher. This could be a very interesting trade to ride out the volatility, and I might even be participating in it myself. Gold not looking too bad at all, guys, trying to recapture the weekly timeframes. And if I had to set a stop loss on this trade, very simply, it would be below 2580. Why? Because if you lose this level, you forfeit the possible weekly uptrend and you just go into more weekly downtrends and you will go into further monthly consolidation. So the trade here is just we are going to make an attempt at weekly uptrend recapture, which is why we put a stop here, because if it does not happen, then our thesis goes underwater. So that is everything, guys, for your stocks, indexes, and commodities, some commodity rundowns. Hopefully you appreciated that. Bitcoin and crypto, guys, be careful with this one, right? I know we are holding the support range on Bitcoin down here, 91.7 down to 87.6. But you guys know if the SPY and the QQQs continue dropping the levels, we have so many volatility catalysts in the month of January. Do you guys think Bitcoin has a great chance of holding up if the markets truly just slow bleed the entire month of January? Probably not. So I wouldn't put all my eggs in one basket and rely on this area of support as if it's the God tier level of support. We can very easily flush this level. And trust me, if we flush this level, there will be a little bit of panic and accelerated sell-off to the downside. Already we've lost all momentum, could be shaping up for a lower high into lower low. That being said, we are trapped like semiconductors trapped between overhead resistance, which is 101 down to 97, and trapped above support, which is 91.4 down to about 86. I would be very cautious on Bitcoin moving forward. I am a big fan of buying the dips. However, you got to be careful, guys. If we flush these lows with weekly candles, it's looking not too bad right now. Weekly uptrends are maintained, but we are in consolidation mode. And you saw back here, we can lose the weekly timeframes and go lower. If we lose the weekly timeframes, guys, we are very quickly going to approach the $85 down to $80 region, 80,000 that is, and put a lot of fear and panic in the markets and some liquidation events in crypto as a whole. As of right now, we have not lost any major levels. It's holding up better than the SPY and the QQQs, but do not rest on your laurels, guys. You have to identify what's happening in the markets right now, which is why I say we could see some further consolidation on Bitcoin, which is why I will be very patient to add to any Bitcoin longs. So the same thing goes for Ethereum. As a matter of fact, Ethereum is looking worse than Bitcoin. Forfeited the lows, any bounce will be looking for a lower high, maybe even to lower low flush. Again, nice support below us, 32 down to 31, but they can take this one out as if it's not even there. You guys know crypto. Ethereum is no stranger to putting in 10% downwards candles, and one of those will flush this level and send us lower, 29 down to 27. That is my more optimal location, but if we flush, guys, it's not looking the best, right? It was a very nice weekly uptrend. We wanted continuation, not getting it. Flush these lows, Ethereum as well. Weekly downtrend, and we're going lower, 29 to 27 is the target. Take a look at the monthly as well. Failed breakout, now might just be heading to more consolidation levels down there. And the same thing goes for all other cryptos, guys. All the other crypto sectors, take a look at dominance. Dominance, we were trying to get the breakdown of dominance, and you can see what's been happening, right? We are not getting it. Bitcoin has been holding up much better than the rest of the altcoins. And if the markets head into further consolidation late January into early February, what do you think is going to happen? Bitcoin is going to drop by, let's say, 5-10%. What are altcoins going to do? They're going to drop 15, 20, 25, 30%. So what do you think is going to happen to Bitcoin dominance? Well, the chart's going to go up because Bitcoin's going to be going down slower than other altcoins, which will mean it will be stronger. Even though they're all dropping, Bitcoin will be stronger. So now might not be the best time to position in altcoins. I have been buying the dip, but I've been telling you guys this entire time, I'm buying the dip, but super slow. If I have $2,000 for an altcoin, over the last 3 weeks, I've been literally putting in $150 a week. I still have so much money left to buy altcoins, but I do not think that right now we're in a favorable environment for crypto to run or the risk on trade as a whole. I'm not saying we're done for crypto for the year, just as I'm not saying we're done for the SPY and the QQQs. But throughout the end of January, I'm just not going to take the risk if I assume that I can possibly get better pricing. I am still long, but I'm not long with the whole bag, guys. I'd say that in crypto for my swing trades, I'm probably 60-70% cash and only 30% invested. So that should give you a good idea of how I'm positioned myself. Now moving into our big tech names. I know it's going to be a long video, guys. Probably the last of its kind. I know I've been saying that for the last 2 weeks, but now actually I've given you guys the full rundown of the market thesis. We've went over all our major sectors, so none of this should come as a surprise to viewers of the channel that are on a recurring basis. Maybe if you're new, but moving forward, I will be referencing today's video as the video to watch if you want my view on the markets as a whole. So moving into Apple and big tech, we'll run through these a little bit quickly. That being said, Apple daily downtrend clear as day. And I was telling you guys when we were up here, right? This is maybe not the best position to be buying Apple longs. Wait for the breakout, wait for the retest. Now we have the retest. However, am I interested in this retest? Maybe not so much because of how SPY and QQQ have lost the weekly uptrends, right? So the retest was nice if the SPY and the QQQ would have held up their levels. They have not. So be very cautious with Apple right here. Coming in hot, breakout retest, still a lot of space on the weekly. It is still a weekly uptrend looking okay, but keep in mind anything above 219, looking for a weekly higher low. I would not be surprised if we come down here and touch the 26 EMA. Apple for me, guys, I might be interested if we come back down 220, right? Just giving myself a good margin of safety. Why? Because in this market, valuation matters. And Apple right now at 220, even at 220, would be a 3.2 peg. Not the company that I'm screaming to get into right now. If we get a further sell-off at that 220, even a 310 peg or 320 peg, I will be looking lower with some short puts, guys. And down there as well is the 200-day moving average. So although Apple is coming into a breakout retest, guys, I cannot trust it the same as if SPY and QQQ were near all-time highs and with daily and weekly uptrends, and Apple was the only company putting in this type of retest, right? It's two completely different trades. Trading is never about real estate, guys. It's not real estate. It's not location, location, location. I forget about all the context of the rest of the markets and I just buy when it gets here, right? Probably not going to have the best results, so keep that in mind. Apple, I am interested in this trade, but my true levels, guys, I want 220 on the price, which means that it may free up some short puts, 210 and even lower. I'm going to be super cheap through January and February, guys. Not going to get trapped on these names that have run a lot. Definitely not going to get trapped on Apple at its high valuation. Moving on to AMD, and they have earnings as well at the end of the month. Moving on to AMD down about 4.76%. Well, AMD just continuously struggling. We knew we had the daily uptrend going back here. We were waiting for, can the bulls push more and more into these weekly highs, which are up here, because it was a weekly downtrend. So it argues that if you have a daily uptrend, you need to see more and more ground gained on the weekly to give the weekly bulls their own shot at reversing this into a weekly. And I was saying the bounce on AMD, guys, was 50-50. It was a 50% retracement, 50% odds of the flush and 50% odds of moving higher and setting into a new weekly uptrend. Unfortunately, we got the downside result, right? So that being said, downtrend now, well, not downtrend, we need lower high into lower low, but not looking good. Flush of all the lows, AMD extremely weak on all time frames. Weak on the monthly, no monthly uptrend. Weak on the weekly, no pun intended, right? Weekly downtrend as well. Touching into the 200 weekly EMA, but once again, this is not real estate. I say it's a good level to start to pay attention to it. I'm not saying you buy the 200 EMA blindly, right? No. The context matters, guys. So as we move further and further down here, 115 down to about $100, this is the last big area of support. We are currently trading right now on AMD at a 1 peg, even lower than a 1 peg right now. I will be interested to write some short puts under the market, but am I going to be writing super close? No, I want to get the best deal possible. I want to be writing 105 down to 100. I don't mind taking shares down there, but I am going to be very greedy with it. So AMD, no major timeframes, no monthly, no weekly, no daily. So why would we be in a rush to buy here when SPY, QQQ are in daily, weekly downtrends? AMD has no higher time frame trends whatsoever. The valuation is good, but it doesn't mean we have to aggressively be buying here. No, we still stay conservative, guys, and we play the price action. If the price action is hinting we are going lower, then of course we need to be writing short puts, possibly below 110, as close as possible, 105 to 100 to get the best possible valuation. And right now, although I do have one small leap contract for AMD for $2,000 with a year's worth of time, I don't have any shares. I don't have any short puts either. I will be writing more short puts down here, which I think is a much more attractive level, because the thesis for AMD, I will remind you, it is part of the favorable trade for 2025. They should be expanding EPS in a very nice fashion. They should be expanding revenue in a very nice fashion. And even if they do not expand it as aggressively as people thought, right? Even if you cut this EPS by 50%, you would still largely be trading, right, at not that bad of a valuation as a whole. So all in all, guys, right? All in all, not that bad of a trade setup, but you have to be patient because you do not have any high time frames. Moving into Amazon right now. Amazon was down 1.44 on the day on Friday. Same concept for Amazon. As you can see, they're starting to degrade right now. Loss of the daily uptrends, loss of the short-term moving averages, which we have not lost since a very long time. We have not really lost the 26, guys, since all the way back here in the month of October. That being said, daily downtrend is in motion right now. Weekly also, guys, this is weekly consolidation, arguably a weekly downtrend. Lows, flush of the lows, similar to SPY, weekly downtrend in motion right now, which means, look at these monthly candle close. Weekly downtrend means you're going for monthly consolidation. After 4 or 5 months of rally, it would definitely make sense. Look, Amazon, 4 or 5 months of rally, monthly consolidation. 4 or 5 months of rally, monthly consolidation. 4 or 5 months of rally, you guys be the judge, right? Possibly monthly consolidation. That being said, I love Amazon. I think they're going to have a great 2025. But maybe not such a great early 2025, right? But I do believe at the end of the year, when we get through these fear catalysts, could be good. Next area of support down here, 215 and about 208. Very decent level, but I want to be cheap. In this market, guys, you're going to see me. I'm going to be so cheap. I will only be interested in Amazon if I can find some shares, 205 down to 200. Why? That is the 26 EMA. Usually that gets tested in times of uncertainty. Here is April, right? Here is the month of August as well. So as we can see, if we look on the monthly time frame, we would just be looking for a monthly higher low. So I'm going to be targeting those monthly higher lows, and we can come down very quickly into the $200 range, which would mean the 12 EMA would be pulling up. Something like this: January, red February, pullback, and then rally extension into 2025. Would that look so bad for Amazon? No, it would look completely logical. So that's why I'll be sitting down here $200, and also why I closed my leap call up here, because that is kind of what I'm expecting. If I'm wrong, I'm wrong, guys, but I would rather be safe then sorry, in these markets, just lock in some profit that we've been riding for, 1 to 2 months at this point. Moving on to Google. Google down as well, 1.14%. 1.14% to the downside, still in the context of a daily uptrend. However, Google is in a daily uptrend, but the rest of the market is in daily and weekly downtrends. Do you guys think Google can protect themselves, or do you think Google might get dragged down with a bunch? Well, the probabilities are tipping that Google might get dragged down with the rest. That being said, they do still have a very nice daily uptrend right here. We are above the slight area of support, and I say slight because it's not that strong, guys. Prior all-time highs and a little bit of basing area right down here, but all in all, it's not the strongest level. What is the actual strongest level? The strongest level becomes this level down here, 182. A lot more price action was had in the 182, and the moving averages are down there as well. That would be synonymous with a weekly downtrend, and you guys get the drill by now. That would also be synonymous with a monthly consolidation phase, right? 4 or 5 months of rally, down into some consolidation, 180 to 175, 12 EMA catching up. Would this look so awkward for the markets in 2025? No. So this is what I'm waiting for, guys. 180 down to 175. You will see me go once again very heavy on Google, but as of right now, I have closed my leap on Google, arguably at the highs of the rally. Got very nice pricing on the Friday close. I got all the way up here, guys. When the markets were rallying on Google, I got the close are virtually very close to all-time highs. So if they choose to consolidate, this is where I'll be building positions with some swing trades, call options, yes, and short puts as well. I think Google's valuation down there will be extremely attractive. Still one of my favorite companies for 2025. But right now, the whole market is telling us something, so we need to listen. Meta bucking the trend on on Friday, 0.84% to the upside, not too bad at all. What is Meta looking like right now, guys? Well, still in the context of a daily uptrend, but similar to Google. Do you guys think Meta can keep it up when the rest of the market is going down? It's harder and harder for them to do that, right? That being said, coming down into support, 597 down to 582. We will see how it reacts to it. Can we continue the perpetual daily uptrend into all-time high 634, or do we just start unraveling? Well, the weekly time frame doesn't give us that much more guidance either. In the event we flush, that will be weekly downtrend, and in the event we flush the weekly, you guys know the drill. Monthly consolidation is coming our way very shortly, and that would be 540 down to about 530. That will be the area that I would be very keen on shopping for Meta for. So if Meta has, from the all-time highs, a pullback of 15 to 18%, it has always been a very good opportunity. Look at all the times it's happened in the past. Whenever Meta has pulled back 15, 20% from the highs in the context of a bull market, usually a good time to buy. So Meta for me will be a buy down here, 540, 530, not $1 above. I will be patient on this one. And if it just runs away from me, no problem at all. There's tons of other trades in the market right now. Moving on to Microsoft. Microsoft as well, down 1.32% on the Friday session. So you guys can see something clear that's happened on Microsoft, right? Clear loss of bullish momentum, daily downtrend, lower high, and now possibly lower lows as well. That being said, we are coming into a short-term area of support, which is currently 417 down to 412, bouncing off nicely the 200-day EMA. But where is the larger area? Where could we actually come down into if the SPY and QQQ drop further levels? Well, the answer is very simple. 403, 405, down to about 390. The bottom end of the support range that's been in the case since 2024 has started pretty much. Why do I like that level, guys? Because this entire time, Microsoft's been doing nothing. However, they have been improving their fundamentals, improving EPS, improving revenue, and improving guidance. So when a company is improving their fundamentals, but the stock price is moving higher, it means that it's getting cheaper and cheaper, all while it's consolidating sideways, which is why Microsoft, I love this stock, but I will be looking for lower. If we flush the levels even more, and I can get some short put opportunities down here, 405 down to 390, even some call debit spread, some leap calls, I will be a very, very, very big fan, especially if we line that up with daily oversold conditions. Those are the levels that I will be patiently waiting on Microsoft for. I do still have one leap contract that we bought back in this location around the 415 level, 416. If it comes down and I become break even, no problem at all. I have enough money to DCA if we come down to my actual desired level, which is down there on Microsoft. All in all, though, holding up right now, but not the best look. It is a weekly uptrend, but we've given back a lot of the momentum. Could we get trapped between this level and this level again and just oscillate here as markets try to figure it out? Yes, absolutely. And I will be patiently waiting for the lower end of support. Now, moving into Netflix, shall we? So Netflix down about 4.26%. This was another one of the hype trades, guys. It was nothing but vertical. And I want you in January to stay away from the vertical charts that have extended too far away from the weekly and the monthly 12 EMA. Just look at all of them, right? Look at Palantir. Palantir, way too extended. Look at SOFI. SOFI, way too extended from the EMAs. Look at other names like IONQ, way too extended from the 12 EMAs. Look at names like SoundHound, way too extended from the EMAs. Now, Netflix is not a meme stock, but what I'm trying to portray here is the fact that when stocks run a lot at a company like Netflix, who is not used to monthly overbought conditions, now starts to set a local top and comes lower, we are going to probably come very close to the monthly 12 EMA, which is down here at about $720. Now, I know what you guys are thinking. Oh no, we're going to drop a lot more. Yes, we possibly can, but in the context of the things, guys, Netflix can always drop. It's dropped several times from the highs to the lows, anywhere between 15 and 20% over the past couple of years. And every single time it has been a buying opportunity. So just focus on that. Yes, the weekly time frame is not looking bad. We still have a very nice weekly uptrend right here. We are trying to set weekly higher lows. And as you can see, look at the MACD on the weekly crossing, coming out from overbought conditions, which is why I was saying I'm not a fan of buying Netflix up here. Be careful, because eventually we are going to need monthly consolidation. Netflix does it all the time. Beautiful rally, monthly consolidation. Beautiful rally, monthly consolidation. Beautiful rally, monthly consolidation. Beautiful rally. What do you think we're having right now, guys? Monthly consolidation. It does it all the time. This is just normal price action for the markets. That being said, next level I'll be targeting is 750 down about 720, as close as possible to this 200-day, because on the monthly we have so much space. Anything about 583 on the monthly higher low for further trend continuation. So I will be patient the entire weekly consolidation. The entire time we are in a massive daily downtrend, I will be very patient, barely daily oversold at any bounce. We'll just be looking for a lower high into possibly lower low and continue this weekly consolidation, not even a weekly downtrend just yet, and monthly consolidation as well. I will be patient. If it doesn't come there, no problem at all, guys. I have tons of Netflix shares in my long-term that I've been buying since 2018. I have tons of long-term shares, not in a rush to buy anymore, just holding what I have. Now, moving into NVIDIA right now. NVIDIA, time for a coffee sip. 3% to the downside. So NVIDIA 3% to the downside, guys, undoing the entire momentum rally into the all-time highs. So what do you guys think is going to happen, right? Daily uptrend was nice. Can NVIDIA put in another V-shaped recovery? Well, at this point, it's getting a little bit dicey, right? We know that resistance is above us right now, 147 down to 141. If anything, might just be looking for a lower high. Then it's up to the bulls. Can they reset this in a two-step process? Or do we just set the lower high and flush? Well, either scenario, guys, I'm good. If we go to the long side, I have some NVIDIA exposure. And if we come down to the short side, I will be looking to build more NVIDIA exposure, because I think they will have, especially after the guidance that they've given in the last 2-3 quarters, they should be having an amazing 2025. And the valuation, contrary to what most people think, is actually not that bad. At 135 with forward guidance, they're only trading about under a 1.9 peg, which is not that bad for the amount of growth and the sector leader status that NVIDIA has, let's be honest, right? That being said, lower support is down here, 130 to 125, but look on the weekly timeframes, look at this weekly candle, not the best, right? We tried to go for the weekly uptrend shift. The bulls still have a little bit of space, anything above 126 to set up for the weekly higher lows for the trend continuation. But if the markets unravel, do not be surprised if this level gets tested even maybe further, guys. We can be currently setting again for the monthly higher lows for further trend continuation. And I, for one, I don't mind the 130, 125, but the actual level I truly want, guys, is 119 down to 110. If I can find some short puts with some good premium down there, I will write here all day, because that is where I want to buy more shares of NVIDIA. So right now, I'm not saying the bulls are going to come all the way down there. Anything can happen in the markets. I'm just saying if we do come down here, I will be looking to write short puts down here. And that is the best way that I can possibly play the volatility, is writing options to buy stock where I actually want to buy stock. Moving on to Tesla right now. Tesla down about 0.05%, trying to find somewhat of a base of support in the whole 408 down to 378. Need to hold this level, guys, crucially important, because if not, we are just going to hemorrhage into further and further daily downtrends and come into the prior level of basing out of support, which we were in just in the month of November, which is 360 down to 330. Now, if you ask me where I want to buy Tesla, where I truly want to buy Tesla, guys, you might not like the answer. That will be below 330 down to 300. I'm not saying it's going to get there, guys. I'm saying that is where I want to buy Tesla. So the way that I'm playing that is if we come down a little bit further into 360 and lose this support zone and retest some of the weekly levels down here, well, that will probably free up some short put opportunities a lot lower. 325, 310, 300 will all be fair game with increased volatility and a big Tesla flush. So that is how I'm going to be playing this one. I'm not buying calls here. I'm not buying shares here. No, I want to go for the absolute destruction. I'll be looking to write short puts, 330 down to 310. You might find that's too conservative, and it is. But in this type of market, as I said, guys, I'm on the side of the road, 4 blinkers on, windshield wipers on. I am being more cautious than not. And let's be honest, guys, in this market, as I said, valuation matters again. Even though Tesla has a lot of long-term positives for it, we cannot deny that the levels here are quite overvalued. And I say that as a Tesla shareholder. And yes, I'm projecting for the growth in robotics and robotaxis through 2030. It is objectively an expensive company up here. Down here, it is not expensive. Up here, it is expensive, and that is just the fact of the matter. So although we do still have the weekly uptrends, I'm looking for lower, and I'm looking to buy the dip lower as well. That being said, the bulls have not lost all the ground just yet. They have an opportunity to reset the daily uptrend, but you have to get your butts in gear because flush 373, and we are heading to 360. Moving on to Palantir now, another trade that's unraveled on a lot of people, right? Nobody thought it could happen. How can a stock that's possibly trading at a 7, almost 8 peg possibly come down 16, 20% from its all-time highs? Well, welcome to the business where valuation starts to matter again. It did not matter when after their earnings and after the election, you had a convergence of bullish catalysts. You have a risk-on environment in the markets led by the Trump election, led by Palantir's bullish earnings. It was a perfect storm of bullishness for Palantir. Now that perfect storm is losing its elements one after the other. Daily downtrend. The last time we had a daily downtrend on Palantir, well, I'm glad you asked. It was all the way back here in the month of August. Now it's a little bit more pronounced, and we have lost all the short-term moving averages, which we use for momentum follow-through. We have not lost the 26 moving average on Palantir, I will remind you, since the August sell-off. So it has to be meaningful to you that we might just be due for a little bit more consolidation. That being said, even if the bulls do bounce, we are going to encounter resistance very soon. Prior support, current resistance for the markets, moving averages as resistance as well. And the resistance as well, guys, is the valuation, right? Now the valuation matters, doesn't it? So moving in, 70 all the way up to about 72 can be future resistance. We will see. Can the bulls pull off a decent sized bounce, get the daily uptrend back? Or do we just possibly set the lower high and roll over? That is probably the more likely scenario, which is the rollover. Why? Because on the weekly, we haven't really given back that much. Yes, we've cooled off the higher timeframes on the weekly, but look how much space they have. Anything above 41, looking for a weekly higher low for possible further trend continuation. If you ask me where we could possibly pull down to, well, between the 12 and 26, you can see all the consolidation periods on Palantir so far have brought us anywhere between the 12 moving average and the 26. So that means it's a very wide area because of how much we've ran and how fast, right? 66 down to about 54. I know it's a very wide range, but somewhere in there. So obviously when I give a range, I want to be targeting the lowest part of the range as possible. Meaning if we continue flushing on Palantir down here to 60, I will be writing short puts $55, $50. I know it sounds very low because it is. I want to be very conservative. When valuation is a question, when you run out of bullish momentum and there's a lot of uncertainty in the catalyst, SPY QQQ, weekly downtrends, monthly downtrends, well, you know that you have to possibly set your price targets a little bit lower than we might have been able to do when there was none of this uncertainty prior to Jerome Powell, right? So keep that in mind for Palantir. I still am a fan of playing this company, but I want to play it as cheap as possible. And for me, that is $50 all the way down to about $55 for some short puts in the market. As of right now, no trade for me, guys. We're equidistant between my level and the all-time highs. So in my opinion, the risk reward right now is not the best considering the market sentiment. But all in all, Palantir, guys, they still have all the trends, but we need to consolidate on the monthly. Nice rally, monthly consolidation. Rally, monthly consolidation. Rally, monthly consolidation. Now, super extended monthly rally. So what do you think is going to happen? Probably some monthly consolidation down into maybe the 50, 55 range, which the 12 EMA on the monthly is going to catch up into. And now lastly, SOFI. So SOFI as well, down about 2.75%. Another one of the hype and momentum trades kind of waning here. So daily downtrend is clear as day. Flush the lows again. That being said, we are desperately trying to hold on to the weekly 12 EMA and also desperately trying to hold on to the last line of defense, which we established as prior support, which we're right there right now. 1363, guys. We are barely holding on to it. So we'll see what happens. SOFI in the context of a weekly downtrend, clear as day. And monthly is forming a monthly consolidation phase pattern as well. So beautiful monthly rally might just be due for more extended monthly consolidation, maybe down to 12 and 11. This is where I want to buy SOFI potentially myself 12 down to 11. I'm not saying once again it's going to get down to. I'm just saying where I want to add if ever it gets there, right? I'm in the business, guys, of predicting the markets where they're going to go. I'm giving logical levels where I want to buy the stock. Confluence here of some moving averages and the closest area where you have any defined price action from the prior lows of that level. Because as you can see in here, in the middle between 15 and 12, there's not much, is there? There's a big gap to be filled there. So if we come down, this is where I'll be averaging into SOFI myself. I know you guys don't want to see it go down there, but in this market, as I've said many times so far, you have to be in the business of hoping for the best, but expecting the worst, especially with all the volatility catalysts on the horizon. And that is it for your index rundown, your big tech rundown as well, and a big precursor to this video, which was a full analysis of the current market environment. So hopefully you guys learned a lot from that. Now, let's take a look at some of the trades, shall we? So moving on to some of the trades, I'm going to maybe spend 5 minutes on this because I know the video is getting long. But as I said, this video needs to be long because there's a lot to be said. We have to talk, guys. When there's a big market narrative shift, we have to talk. I gave you guys a very long talk after Powell. I gave you one right before New Year's, and now I'm giving you one again. So I've put out a public warning or caution 3 separate times now for us to pay attention to the shifting market narrative. So hopefully you guys are able to decide what you want to do, whether it being you have a decision to make. You either ride the volatility and act like there's been no market shift, you act like nothing's happened, or you trim and you wait, right? So now let me show you how I'm trimming and waiting, because that is what I personally want to do. Everybody's different. Everybody has different risk tolerance. For myself, I would rather be safe than sorry, especially sitting on a lot of gains, not going to round trip any gains. And I'm also not going to get trapped at local market tops, buying the dips too shallow, right? So that being said, let's go over some of the trades that we've closed that you guys will not see in the portfolio anymore. And now 3 wheel trades here, very, very easy trades. We played some BITX 49 short puts, 27 cents. They expired worthless, 100% profit. TSLL playing 2 times Tesla leverage, but with a lot of margin of safety. Talk about this one in the top 5 options trades a lot. 23.7, 17 cents. They expired worthless. Another win there. And AMD, we had this AMD trade put on midway through December, and we went with the 120 puts for this Friday that just passed expiry. Now, good thing I closed this trade on the Monday session when I did, with the nice little bounce here on AMD, closed it up here, right? Good thing we closed it. When we did, we took a ton of profits, which is why I always tell you guys, set take profit orders at 90% of the contract value. Every time you guys look at my wheel strategy, right? Every time I talk about this once every week, what do I always say? I always say you take the profit and 90% of the contract value. It's not worth holding into Fridays, guys. And that is exactly why, right? So we took a decent amount of profit on those AMD longer duration puts, 120 puts, $3. We closed them at 18 cents, which is 94% profit, 280 bucks in our pockets. For the assignments, SOFI, we are still running SOFI assignments at $15, but we wrote some juicy covered calls for $1.18. It brings our assignment basis on SOFI now down all the way to the lower end of $13.61. So I am in SOFI with 100 shares, but my cost is below the current stock price, which is why I only want to be DCAing if I get 12 and 11 and reduce this cost basis even more. So I am in this trade, guys, but I'm not done building my position. That being said, if we take a look as well, at the direction, NVIDIA, I closed NVIDIA. You remember I had the 137 short puts that we've been running for a while. We got assigned on them early in the stage of December, and ever since then, we have been writing a ton of premium against this trade. Take a screenshot if you want. We've been over this a few times. I closed the trade on the Friday. Even though we were under my assignment price 137 and I had covered calls, we were at profit on both. I closed the shares for what they were, 136.50, and I closed the remainder of the covered calls, which I got for $1.80. We closed them at 28 cents. The entire result of this trade since December assignment has resulted in a $603 profit on NVIDIA. Why? We reduced our average cost very well to $129.69. And even though I sold slightly under my assignment price, and there was a little bit of remaining contract value on the covered calls, we were able to lock in $603, which is $120 a week, which is on the exposure, 0.8% per week, respects my wheel minimums of 0.5% per week. This one was a fantastic trade. Reduce the risk. We're out of that one. Now I can choose to buy NVIDIA a lot possibly lower if we drop a little bit lower. So that is some success trades recaps as well. And now lastly, for the directional trades, $5,338 of profit realized. ASML was a call debit spread. You guys remember I put this one on October 15th of 2024, guys. October 15th was after the initial drop, after the big news. Unfortunately, we were expecting a bounce. The bounce never happened until very early this week on the Monday session. And when I saw the Monday session, I was like, you know what? Let me just close this one for any remaining capture value in the contract. It was always going to result at a loss, guys. You know, we bought it 15th of October. Here pretty much, and we pretty much burned all of the time on the debit spreads, so it was tough for us to get any profit unless it pushed higher. And I knew that in this market landscape, I may as well cut the trade for what it was. We cut this one for a roughly 45% loss, but to be honest with you, it's been in a loss this entire time, right? So we cut the loss for roughly 45%. Normal. I've been telling you guys on the channel, this one would probably result in a loss. I went in a little bit too early, but at least I did not go in with a lot of size. Only $108. Now, Google, we closed the leaps. You remember I bought the leaps, guys, September 9th of 2024. Where were those Google leaps bought? They were bought at the absolute fear bottom. September 9th is here. We bought the absolute bottoms, and as I showed you, I sold for all intents and purposes at 195, which is pretty much the cycle top. Not cycle, but you guys know what I mean, right? The rally, some of the rally tops, at least local tops for now on Google. I'm very happy with this trade, guys. We made a ton of profit. $3,664 of profit, 127% ROI. And we also got some covered call profit on this one as well. $172, an extra 21% ROI. So we made a ton of money, guys, on this trade. You know, arguably almost $4,000 on those Google leaps. And that was just one contract. Very easy trade. Amazon as well. Very easy leap trade that we put on earlier, November 11th after Trump. When Trump came into office, we saw the risk on movement. That was the time to put your foot on the gas, right? So now we're taking a foot off the gas, we close the profits. Almost $1,000 profit on these leaps as well, 22% ROI in just over about almost 2 months of trade in that leap. We also had 2 batches of covered calls, one that expired last week, which we collected $360 on, 75% ROI on the covered calls, and the one for this week, $20 profit only because I just closed out of the trade as a whole, guys, right? So only $20 profit. The covered calls were all the way till January 31st. So normal, I didn't get a lot more than that, right? 5% there. But if you add up everything, right, $990, $360, and $20, we're sitting at almost $1,400 of profit in just over 2 months of time, which is like arguably, you know, 30% ROI on leaps. Fantastic. Well, I got into Amazon at about 207 to about 223 when we closed it, guys. Pretty good ROI, right? And now lastly, Uber, one of the Uber leaps, 1 out of 2 partial close, $12.10. We bought it when Uber was roughly $60, closed it when it was $66 on Friday, $12.10 to $15.30. That is $320 in profit or 26% ROI. The trade was placed December the 11th, so just under a month of trade. All in all, guys, very good week, but we took our foot off the gas, collected a lot of profits that we were running, don't want to round trip any gains, and now I have an absolute metric ton of buying power. So let me show you the account. So starting the account, as you guys knew that I was pretty much taking you guys on for the journey with me together, we started the year with roughly this amount. Literally, I was saying, right? I started just under 50K to provide a good glimpse into what you can do with about $45,000, $47,000. So we'll see how we can ramp up this account. As of right now, we're still sitting positive for the year. I know you can't see it right here, but we're still up about 2%. This daily P&L is not accurate. I don't know why. We were down about $800 on the Friday session, but all in all, not that bad. We are still positive, and just above where we started off the account, about 46 something. I started at 46,800, something like that. So you are still up a little bit, but of course we have given back a decent amount of profits this week, but at least we were able to kind of close the remainder of the profits that we had, and that's pretty much it, right? So as a whole, we still have all the position, well, not all of them, but I have de-risked a ton. Look at the amount of buying power that I have right now. Almost full buying power. I have not had this amount of buying power since Trump was elected, essentially, right? Now we're back full buying power, and the market value of all these positions is very low right now. So I'll show you the ones that we have added to the portfolio. So of course, we still have some of the value trades in terms of some of the value trades, Berkshire, we still have that call debit spread, but it's coming into stop loss territory. Might close it next week. AMD still have the calls that I bought, 2186, but with the premium that we received from the short puts, about $280, I will add this to the same trade. So we are down $746 on those. I have a lot of time on them still. I will add the premium to this one, so the loss is not all that bad in hindsight. We have Ethereum U $6 puts for the Friday session. I'll probably close those on the Monday if I can get 10 cents. Just close all the profit that we have running right now. Not too bad of a deal. The EVVTY shares still have planted. Love the company. Still have a couple of calls here. KO is a call for May. Intel and KWeb, those are asymmetric bets. Those are leap calls on the recovery story of Intel and the recovery story of China. So I wouldn't pay too much attention to the running losses there. I have so much time on these that I'm not worried at all I'm just going to let them play out. Moody's Corporation as well has dropped. We'll see if those hit the stop loss level too. Microsoft still in this one with some call debit spreads. And I do still have some, I forgot to take a screenshot, but I'll show you guys on Monday. I still have a leap for Microsoft, a leap for NVIDIA that's not in this portfolio, and another leap on Uber that is not in this portfolio as well. Micron asymmetric bets. We're still up on one, down on the other. So I'll stick with those as well. We have the NVIDIA 140 short puts that I showed you guys. Our break even is right under 134, which is why if I do any more of these, this one's for February. If I do any more of these, this will probably be for late December. All in all, though, SOFI assignment, we've covered that already. SOXL, this is a call option that is now covered. You can see it's now covered, so we'll keep that one. SPLG, this is just a smaller version of the SPY. 68 short puts for Friday, so we'll see if we get assigned on those. They have monthly contracts, so we'll see if I get assigned on the SPY. You guys think I mind being assigned on the S&P with some short puts down here at 68, which is the gap fill level? I don't mind. And as a matter of fact, I will be averaging into this SPY trade. So if you guys are looking to play some short puts on the SPY, I like to use SPLG. It's cheaper if you have a smaller account. Square, we still have the leap calls here, but we've already closed 2 of them. A couple of them remaining. I may just take one more off the table. You can see we had some covered calls here. We've pocketed pretty much $437 on the covered calls. So at least it's reducing our loss, well, not loss, but it's reducing our cost basis on this trade a little bit. TLTs, those are pretty much gone. Those were hedges put on in the months of August and September. So far, they have not played out, and I don't expect them to play out. So we've lost all the money on that one, but they were just hedges, guys. They were hedges, and as a result, I'd rather my hedges go down than the entire portfolio go down. And Uber, we still have the assigned shares that we got at 66 bucks, and now you'll see they're slightly below that. And UNH and WM, well, those are also value swing trades. The UNH and WMs are still up right now, but I may just be closing all the value trades I put on. UNH, WM, Berkshire, and MCO, they kind of all offset each other, right? Some are at profits, some are at slight losses. We may end up taking a loss on those value trades that I put on slightly after Powell for the value trade recapture. But if the markets are not going to cooperate and yields are going to be high, I may just take some of these off, right? But all in all, you can see no massive positions for me right now. I have all the buying power in the world to buy the dip with. We've mitigated a lot of the losses. We've covered up what we can cover up. We've closed the trades that were at profit that we wanted to close, and that is currently where we stand, guys. So we are at a profit for the month of January. I know it's not a lot of profit, but we took a lot of stuff off the table. We have a ton of buying power, so I will be looking to buy these dips, and I'll let you know, of course, when I do start buying those dips. So that is everything we had in store for today's video. I know it's one of the longest ones I've made, but when you have a shift in the market narrative, I think it's important for me to outlay the reasons for the shift, what I plan to do moving forward, give you guys a ton of levels for short, medium, and long terms, and also show you guys the portfolio in full transparency, the wins, the losses, and how I plan to trade moving forward, because that is the best way that I can teach you guys, is bringing you along for the journey and how I navigate through these uncertain landscapes. So if you guys enjoyed today's video, despite the length, consider dropping a like on the video. Would appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. We are almost close to 5,000 subscribers, guys. I would love to be able to do that before the month of February. So if you guys can, hit that subscribe button, would really appreciate it. And lastly, if you have any questions on the trading style, the narrative that we're going in right now, anything at all, always feel free to leave it down below in the comment section. I'll do my best to help you out. Usually I do respond within the first 1 to 2 days. And lastly, if you guys are interested in being part of the Discord and having access to all of these trades, these are all the trades. I show them all the time. All the trades since the inception of the Discord. The green check marks are the wins. The red little circles are the losses. We're pretty consistent in there. You know what I mean? So that being said, if you're interested in having all the trades, the wheel trades, the put credit spreads, the call debit spreads, the leap call options, the share swing trades, all the trading styles, small accounts, medium accounts, big accounts, I give them all, guys. If you're interested in the live trades, well, the link to the Discord is down below. We do private morning live streams every Monday to Friday for about an hour or two and live trade and answer all your guys' questions in real time. And also all throughout the day, if you guys have any questions, you can ask me in our chat channels and I will be very fast to answer you all throughout the day as well. We also, I share all of my watch lists, all the support resistance levels, all the notes that I've taken on all of the earnings as well. I share the watch list for all the members, so you guys don't need to do any of the work. You can let me do all the work. You have all my notes, all the watch list too, and tons of other features that I just don't have time to talk about right now. So if all of those things interest you guys, the link is always down below in the description. Would love to have you in the group with us. A lot of our members have been winning and winning and winning and having a better psychological understanding of the markets and how to position in these times. We've been saving a lot of people a lot of money and making a lot of people a lot of money too. So if that's something that interests you, obviously I can't guarantee results, but what I can guarantee you is you will learn a lot in this Discord, possibly faster than just learning from YouTube videos nevertheless. So that being said, the link is down below. Hopefully see you in there soon. And if not, I'll see you back on the channel, guys. That's it for me. See you tomorrow in the top 5 options video for the week. That's it. Have a good rest of your weekend. Take care. Love you guys and peace.